What's up, everybody? My name is Joe Brown. This is the Heresy Financial Show, and today we are going to be looking at some fresh charts that will give us an indication of where the housing market is going. Many people are starting to post pictures all over online about house prices dropping on current listings. And so everybody is saying, hey, the bubble is starting to pop. The crash is finally here. We are going to see some massive carnage in the real estate market. But that's not exactly a total look at all the data. That's looking basically what that really is anecdotal evidence of, hey, there's a house right there. Somebody's trying to sell it for more and now they realize they have to sell it for less. So we want to see, hey, is that communicating something that is indicative of the overall housing market across the entire nation, or is something else going on here? We're going to look at some charts today that will shed some light on the situation. Ready? Let's dive in. First things first, a word from today's sponsor, iTrustCapital. Now, most people today are aware of how well gold has performed relative to pretty much every single asset class out there. We've seen an absolute crash take place in tech stocks, in the broad stock market, in cryptocurrencies. We are seeing blood in the streets everywhere, but gold has been keeping up. Gold has been increasing its purchasing power relative to these other assets, and many people want to buy it, but the problem is most people have most of their wealth tied up in their 401k, in their retirement account, maybe even with their current employer. So the question is, how do we invest in gold with our money if we can't do it where our money's currently at? And that's where iTrustCapital comes in. Because unlike your workplace employer plan, like your 401k, you're not just going to have a selection of a couple dozen mutual funds that are only invested in stocks and bonds. And unlike your IRA with a regular stockbroker, with iTrustCapital, you're not just going to have access to the regular stocks, the ETFs, GLD, SLV, things like that. With iTrustCapital, you can invest in physical gold, physical silver, that's all held underneath the banner of the IRA so that you don't have to worry about any tax consequences. You can do traditional IRAs, you can do Roth IRAs, you can make new contributions, or you can even transfer money from your existing retirement account over to iTrustCapital and use that to invest in physical gold, physical silver. Now, they also have other alternative assets available like Bitcoin and cryptocurrencies. And if you use my link in the description below, you will get $100 worth of Bitcoin as a sign-up bonus just for opening an account. You can use that to keep it in Bitcoin, buy other cryptocurrencies, or sell it and buy physical gold, physical silver, again, in your IRA. With iTrustCapital, sign up with my link in the description today. All right, this article is from a wealthofcommonsense.com. Is housing a bubble waiting to pop? And I sent this article out in my newsletter this week. And so we are going to be taking a look at some of the charts that were included in this article. First of all, take a look at this chart, which is the Case-Shiller Home Price Index. This is what most people look at when they say house prices are high and they should fall. Really, what they're looking at is prices. This is the most uneducated indication of whether something is expensive or cheap, is just looking at price, because it ignores the reasons behind why that price is there. And the reasons behind it are what will indicate whether something is cheap or expensive, not just the price. Take, for example, something like diamonds. Diamonds are something that in nature are extremely common, can be created molecularly identical in the lab. They are not durable, they're not forever. They'll burn up in a house fire, actually. They have a lower burning temperature than the melting point of gold. And so you've got a gold diamond ring and you have a house fire, the ring will still be there. The ring won't even melt. And even if it does melt, like, it's still just a pile of gold now. So the gold is still there, but the ring won't even melt in a normal house fire, and the diamond will evaporate. It'll burn up. It'll be gone. And so diamonds themselves are not intrinsically, I don't like that word, but they shouldn't be valuable like the way they are today. The reason they're valuable is because there's one family, one company that owns all the diamond production in the world. And so they hold back the release of those diamonds. So there's artificial scarcity imposed on the market for diamonds. And there's a lot of money spent on marketing to improve the appearance of the value and improve the perceived value of these rocks. And so people desire them. And so the supply and demand dynamics are changed, driving up the price. That's that's why the price is higher. And so if those supply-demand dynamics were to change, such as, for some reason that family losing control over all the diamond production, the value would plummet because it'd be much easier and abundant for everybody to get their hands on diamonds. So there's something driving the price of houses up. Now, sometimes it's things like, if we look at this chart, in 2005, 2006, what was driving prices higher was poor lending conditions when everybody was getting loans they couldn't afford, adjustable rate mortgages, 2 and 3 different loans. There were empty houses everywhere, driving prices up as there was euphoria, people thinking that everybody would always only get rich from houses. That was a classic bubble. But is that the same thing that's going on right now? Let's take a look. As we can see here, the US existing home median sale price right now is $416,000. Now, this is very high compared to where it was even just in 2019, in 2020, just a few years ago, when the median home sale price was around $260,000. In just a few short years, it has close to doubled. That is a tremendous leap in median price. Now, remember what median is. It means middle. So you've got all the houses that are sold. You take the one that's in the middle of the price list, and that's what the median is. This is a better measure than something like mean, which is average, which is adding up all the prices, then dividing them by the total number. Because then if you have a bunch of houses selling at $1, but one house sells at $1 trillion, your mean is going to be, it depends on the number, but your mean is going to be a lot higher. It's going to be skewed by that one high-priced house. And so median is going to be a more accurate measure here. And right now we're at $416,000. So the question is, well, what happens if something forces prices to come back down and the median home price returns to something like $300,000, $250,000? A lot of people would be in trouble, right? Not so fast. Take a look at this chart, US existing home sales. This shows how many homes are selling during a specific period of time. And right now we're about 5 million. That means during this whole time when prices are extraordinarily high compared to the historical trend, we have not had that many homes sold compared to history. This means that while the median home price is high right now, there are not that many people who have purchased homes at those high prices, and we'll prove it. US home ownership rate right now is around 65%, and that's stayed fairly consistent there. If you look at the axis, we'll see that's only between 62 and 68% since the 70s. This is a very tight range. There's 330 million people in America, so if we had 5 million home sales a year for the past couple of years, that doesn't come close to touching the amount of people out there who own homes. This means most people who own homes didn't buy them within the last 2 years. And if they didn't buy them within the last 2 years, that means they didn't buy them at those extraordinarily high prices. This is why when we take a look at the next chart, we see that US owners' equity in household real estate is so high. Many people bought 3, 4, 5, 6, 7, 8 years ago, and because of the run-up in prices, they just have a lot of equity in their homes now. Further than that, we are seeing a much higher quality of borrowers today than we saw in 2004, 2005, 2006, 7, 8. We can see the credit score is much higher, which we know credit score is a score that is basically derived by somebody's income and their debt levels, their history of proving that they are able to make their debt service payments. Now, since the start of 2020, every time I make a real estate video, I have a constant stream of comments saying, just wait until all the foreclosures start piling in. People are going to be losing their homes left and right, just like they did 10 years ago. And I've consistently said, no, that's not going to happen. One of the reasons that people pointed to thinking that was going to happen was because of forbearances. If you looked at the number of people who said, I would like to not pay my mortgage for the next 6 months, 12 months, 18 months, there were a lot of people. And understandably, if you think all those people can't afford their mortgage, then yes, you would expect that all those people would then foreclose once they're no longer in forbearance. But I don't know what the percentage is, but I would say close to 90% of the people who went into forbearance did not do so because they were at risk of foreclosure. They did so because they were squeezed a little bit financially, and the thought of not having to pay your mortgage sounded really great. So that's why we see, looking at this chart, foreclosures dropped off a cliff in 2020 and are still not anywhere close to where they were in 2016, 17, 18, 19, and especially before that. Why is this? Well, it's very simple. Inflation. The way inflation works is it first pushes up asset prices, then it pushes up the prices of goods and services, then it pushes up the prices of wages. And so when you look at expenses, people will get squeezed by inflation because their cost of living will go up from groceries and gas and rent will go up, but their income won't go up until after those prices have already gone up. This means that people's incomes do go up, but their costs go up more. However, the mortgage is the one cost that doesn't go up for everybody. If you have a fixed mortgage, it doesn't change. This means relative to all your other expenses, inflation makes your mortgage easier to pay because incomes go up, and they do, and they have. Income has gone up despite inflation. Has it kept up with inflation? No. Is that the point? No. The point is that incomes have gone up compared to your fixed cost, your mortgage. That made your mortgage easier to pay. And the leading indicator of foreclosures, the serious delinquency for mortgages, has also dropped off a cliff. In 2020, it fell down close to 0, and we may have a little bit of a tick up in the last couple of quarters, but nowhere near approaching the levels we were at in 2015, 16, 17, 18, 19, and 20. And when you add in the final kicker, which is the fact that many homeowners are currently paying a mortgage around 3%, because when that became available, everybody moved if they could, and if they couldn't, they just refinanced. Now they're looking out at home prices, which are higher than they were before. Home prices still have not started to fall. If you look at the data, don't look at the headlines, the news, look at the data that they're actually showing. Home prices have still continued to go up. Mortgage rates have continued to go up. So you're looking, somebody says, if I want to sell my house, I'm going to have to move into a house that is very most equal, but likely worse than my current house, just to be able to afford the mortgage. And if I don't go down enough in a house, then I'm going to have to pay more for a house that's a little bit worse or the same. There's no way I'm going to take that deal. I'm just going to stay in my house, and if I have some extra money, I'm going to spend it on something else. And so I'm not going to take the deal if I can't afford to buy a new house. If people can't afford to buy the houses now because prices are too high and the mortgage rates are too high, that means they can't afford to sell their house. And 65% of Americans are currently homeowners. So the chances of a massive crash in real estate, especially like the one we saw during the Great Financial Crisis, is very low because there is nothing forcing people to sell like there was back then. Could I be wrong? 100%. I could absolutely be wrong about this. But I've been saying the same thing since the start of 2020, and everybody has been saying that I've been wrong, and still to this day, I've still been right. I'm open to the new data, and every time we see new data come out, I will take a look at it, and I'll let you know once I see something changing. Right now, no crash ahead. Dip? Sure. Crash? I don't think there's a chance. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.